So we've been talking about the liability, asset, and liquidity management at commercial banks. And with respect to the capital adequacy or the capital integrity, the idea is that all three aspects of, or all three pillars of bank management, the asset, liability, and equity, ties into the capital adequacy management. So I was going over this banking supervision document by the European Central Bank, and they have a nice schematic that I wanted to share with you. So for a bank, as you can see, the assets, as we discussed, includes the loans to customers, our clients, and then the investments made by banks. We reviewed how banks can buy corporate bonds or mostly treasury bonds. And we reviewed how within the last couple of years, even the banks that have substantial treasury bonds had to face significant losses. And some of the banks actually had to go under simply because of the losses in their investments. And obviously, as a bank, they need to keep some cash at hand, and some of this cash can be cash-like items like short-term treasuries. And on the liability side, we talked about how loans make up, some of the liabilities that the banks borrow, but substantially or substantial portion of their liabilities are the deposits from customers. So banks can also, issue debt securities. But all in all, deposits are the significant portion of this. Now, with respect to the capital, the definition of capital is the money from the shareholders or other investors. And it's really important because it ties in the assets and the liabilities and the aspect of liquidity together, because banks are not allowed to spend the money from depositors. Meaning, when a bank needs to operate, they will have expenses. They will have the branches, the salaries. They will have day-to-day activities that they need to pay. And a lot of the times, the fees that they charge will not be enough. So at any point in time, the banks need to have some money of their own so they can spend the money to operate as a bank. And they're not allowed to use deposits for spending. So the capital is the fund that is paid up by the shareholders, the owners of the bank, that to begin with pays the operational expenses of banks. And this needs of commercial banks. This needs to be done simply because banks are not allowed to touch the deposits other than using the deposits to lend them out and for their investments, keep it as cash or keep it as reserves. Now, the secondary and probably the most important reason for a capital is that some of these loans will eventually go bad. Meaning, for every $100 deposit that you collect, first of all, you can see that some of it actually is set aside as cash. Some of it is actually set aside as treasuries. However, the substantial amount will be given out as, lent out as loans to clients. And some of these loans will go bad. Credit cards won't get paid. Mortgages won't get paid. Car payments may be missed. And the banks set aside reserves, so we don't actually see it right here, but we also set aside reserves. However, the banks, again, are not allowed to dip into deposits to pay for their losses. So their mistakes, their errors are their own, and the deposit holders should not be held liable for the mistakes of banks. And therefore, the capital is required of banks to pay for day-to-day operational expenses, but more importantly, to pay for the losses that they may incur in their credit portfolio. So If a bank that has a sufficient level of capital suffers a loss, then the capital is actually used to pay for those losses. And as you can see here, every year we're hoping that the bank will have some sort of a profit so that they could retain those profits and increase their capital. However, if they actually go below a certain level, then the shareholders may have to come up with the extra money to pay or to increase capital. So I found this other document by FDIC, which I'm going to share the link for this on Canvas. This actually talks about what purposes the capital serve. And the FDIC, as we discussed in class, the Federal Deposit Insurance Corporation, oversees the financial activities of commercial banks to ensure that the deposit holders, these deposits are not to be touched, to be risked above and beyond the risk of the loans. However, again, those losses have to be, borne by the banks. So first of all, the capital is used to observe any losses. Like we discussed, capital allows institutions to continue operating and as going concerns during period. So think of it like as we have set aside some reserves for potential losses for our credit portfolio. If things start going bad, then we may need to set aside more reserves in case our portfolio starts to crumble. So what happened to, for instance, the Silicon Valley Bank was that their credit portfolio suffered significant losses and their reserves were not enough. And they had to dip into their capital, but it turned out that their capital was not enough. They could not predict how much of their credit portfolio would go bad. And therefore, that inability of prediction cost them their license, and they ended up filing for bankruptcy, or FDIC had them sold to other institution. So the capital size also promotes public confidence. These are all public data. I mean, we can go to Yahoo Finance. And let's take a look at, say, JP Morgan Chase. And then let's look at their financials. And let's look at their balance sheet. And you will see it right here, the total capitalization for a $3.7 trillion of assets. They have about $715 billion of capitalization. And this builds public confidence. Let's take a look at Bank of America. Yahoo Finance, BAC. I go to financials, and then you can look at the balance sheet and notice again that for about $3 trillion of total assets, their capitalization is about $550 billion. So it's about 1-to-6 ratio of the total assets that the bank has capitalization. So this creates public confidence. Now, the third one is that it restricts excessive asset growth, meaning given the amount of capital that you have as a bank, you know the situation of your credit portfolio, and therefore you choose, or you're supposed to choose, how much more risk you are able and you prudently should be extending. In other words, if you only have, say, in the case of $700 billion, in the case of JP Morgan Chase, then you know that your optimal asset size is about $3.6 trillion. So by creating more debt, or by giving out more debt, and by creating more assets for your institution, given the same level of capitalization, then you know, and the public would know that you're overextending your capitalization. So this makes you a riskier institution. So the knowing your optimal capital adequacy ratio limits the amount of credits that you're supposed to pay out, and therefore makes you more of an inline or internal check um, measure. So it makes you more in line with your internal check measure. So it also protects depositors and deposit insurance fund. So obviously, Federal Deposit Insurance Corporation, the FDIC, has limited funds, and some banks are too big to fail simply because their size may be either bigger than the FDIC or so big that their failure would incapacitate FDIC altogether. And if two of them actually go, then the FDIC may become incapable of even helping the smallest of banks. So with the adequacy, capital adequacy ratio, we can actually measure how much of a risk exposure each of these financial institutions exposed the FDIC and exposed the depositors, given the optimal level of capital adequacy ratio for that size of a bank. And I've been talking about a capital adequacy ratio, and um, the ratio usually is your capital divided by how much assets that you have at risk. And there are two tiers of this. The first tier usually refers to the capital that you have, and the second tier is the amount that you can actually extend. So again, the tier one is the capital that you have at hand for your day-to-day operations, and the tier two usually refers to how much you can extend, including your ability to raise funding, your reserves, and your the funds that may be available to you but not immediately in your possession. So having all of that combined provides the depositors with the safety net that's required of banks to function in their borrowing from the depositors, lending it to the creditors, and if there's any loss, I will be to blame and I'll take the shock. However, if the capital adequacy ratio is low, then you have banks, even though they do promise, they may not be able to meet their obligations, and therefore allow the depositors to face certain financial risks, and unfortunately put the deposit insurance at their financial interference or financial regulatory duty. So here is a chart provided by the Federal Reserve, and this looks at the common equity tier one capital ratio and also the share of institutions that are not well capitalized. And this goes from 2006 to 2019, and I thought this was really interesting. On the left, the blue line is the common equity tier one capital ratio. And notice how since 2007 and 8, when we had the financial crises and we had AIC filing for bankruptcy, which was a significant securitization company for a lot of the securitized or mortgage-backed portfolios, credit portfolios that the commercial banks held. So the bankruptcy of AIC put a lot of commercial banks at risk, and from that point on, the capital ratios, capital required capital ratio, has been increased, and it has actually been increasing. So notice how we actually came from almost a little bit above 8%, and then in 2008 and 9, we were almost at 6%, and now we are now at around 12%. So the banks are now a lot more capitalized than they were about a decade ago. So, and that's a good thing. That's good for the banking system, and it actually shows that the FDIC and the Fed has been have been working hard to ensure the capitalization, sufficient capitalization for our commercial banks in our economy. And then the the chart for the orange chart for the share of institutions that are not well capitalized on the right hand side. And these simply mean that when you look at the capital adequacy ratios of commercial banks, you find that some of the banks are not properly capitalized. And the percentage of these banks within the entire banking system is the chart. And notice at one point in 2008 till 2009, it was about the 6% of all banks were not well capitalized. And this ratio has been declining, which is, again, really good. This actually shows that the FDIC and the Fed has been working to ensure that the banks are more capitalized or better capitalized. And we're going to see in the upcoming lectures that the banking system have been consolidating, and that actually has to do with some of these capital requirements that the Fed and FDIC have been requiring of banks to have, which is again better for the stability of the commercial banking system. But it also has pros and cons. From a libertarian point of view, is it okay to require banks to have as little risk as possible and just eliminate all market forces? But from a regulatory perspective, a failure of one bank can become contagious and take several others with them, and FDIC may not be enough to save all the banks that are failing all at the same time, or very close by. And so it's a discussion that's been going on since the great financial crisis that we had in 2007, 2009. And it wasn't just the US, we actually had this crisis internationally. So, yeah, so that's about it for the capital adequacy. And like I said, we, kind of discussed the adequacy requirements when we were talking about the asset management, liability management, and liquidity management. But again, the capital adequacy is the essence of the bank in the sense that they're not allowed to touch the deposits to pay for day-to-day expenses or to cover their losses, and therefore they need to have their own money to cover all of this. And at any point in time, capital adequacy ratio has to be above a certain limit, and different banks, different size of banks, expose our financial system, our commercial banking system to different levels of risk, and sometimes the risk is too big for the FDIC to handle, and therefore there's significant scrutiny, especially when it comes to capital adequacy. When a bank fails to meet their capital adequacy ratio, as in this percent of banks in the system, they will meet with severe FDIC and Fed regulation, and they will be required to either increase their capital or consolidate with other banks, merge with other banks, or their licenses may be revoked and they may be simply merged involuntarily with the other banks. And like I said, in the next lectures, we're going to see how many of those banks are actually failing every year, and how that consolidation took the number of institutions from a little over 10,000 institutions down to about 3,000 to 4,000 institutions recently. So if you have any questions about the capital adequacy, please let me know. And well, thank you again for working with me, and hope to see you guys soon. Thank you. Bye now.